part two of a series we started last week. Tim Davis is a partner with Costangi, Brooks, Smith & Profit. Last week, Tim conducted a webinar on an employer's guide to COVID-19. And as you know, the CARES Act has come out and been approved. And Tim's going to go over that portion of legislation. And I'm going to hand it over to Tim so that he can give a brief introduction about himself and we can get started.
Great. Can everybody hear me all right?
Sure can.
Okay, good. I switched to my headpiece, which sometimes there's a little bit of a lag. But good morning, everyone. It is, I wish I could say it was a pleasure coming back to all of you again for our second part of this series, but under the circumstances, that's difficult to say. But hopefully everybody's doing well and staying healthy and starting to get through this together as we try and get through the next few months of difficulty. Our goal today is to get everybody up to speed on the new CARES Act that became effective last Friday and really kicks in earnest tomorrow for the most part with a large part of what we're going to cover. And so I'm gonna walk through that act pretty much in some detail. And I usually don't like to, when doing slides like this, have too much in depth on the slides, but for the purposes of this information, I tried to really load it up with all of the information available to everyone so that you'd be able to take this as a guide. I'm going to pause at a few moments at what I'll call a yellow magic marker moment, which is really when you want to make a good note of what we're talking about or make a note on the slide if they're available for you to do that, to print out, so that you can really focus on that, because as you're going to hear, time is really going to be of the essence in this thing. And I will also commit again, like I did on the last slide, I've done about 6 or 7 webinars like this for various entities around the country. And I'm doing my best to get through the emails or calls I get from people afterwards. If you do have questions based on what we talk about today, please don't hesitate to send me an email. I'm going to do my best to expedite the questions out of this seminar, particularly for those of you who are interested in doing a paycheck forgiveness or paycheck plan forgiveness loan, because that money is going to run out quickly. So make note of this information on the first slide here. If you've got questions as we're going along, we are going to try and answer them at the end. And then as a follow-up, if you need to shoot one to me, do that as well. I am happy to try and help you out during this time period. So going forward, here's what we're going to try and cover today. We're going to try and cover the new CARES Act. Oddly enough, even though this is very much an employment-related provision, the important people after we get off this call are really going to be probably your banker and your accountant. You can get some advice from lawyers, but this is primarily part of a loan program that's coming out of the SBA. And so when we get done with this, make sure you make a note that those are the people you're going to need to follow up with. Or if you have questions, please, again, don't hesitate to call. I'm also going to give you a quick update on what we talked about in the last webinar just over a week ago, because there have been some updates that are pretty important for you to understand. And I want to talk about a little practical workplace planning for you to try and coordinate these new laws, keeping in mind that everything we're talking about hit us and hit you as businesses in just the last 2 weeks. So I understand you're all scrambling out there. What do we do with our people? Do we try to get a PPP loan? Do we lay everybody off? Do we furlough them? Do we go for unemployment? There's a lot of different factors that go along as we apply. So what has happened since we talked last week? For those of you coming from Kansas, which is where I live, we are still under a social distancing order now that has been extended pretty much through all of April and is likely also going to then be extended through May. Many of you are deemed to be essential businesses and are still operating pretty much as normal, but following the guidelines as requested by the governor's order or the Kansas City order if you're in that area. We have seen a significant increase in diagnoses of COVID-19 in just the last week since we talked. This is not a problem, as we said, would go away in a week. You really need to be looking at your your plan to how to get through the next 4 months and even how to get through the next year as this continues to be an issue. As you probably heard, unemployment claims went up by more than 3.5 million last week, and they've already exceeded that for this week. So we have gone from a country that had about 3% unemployment that is soon expected to cross the 15% unemployment in just a 2-week period. So when we start talking about the unemployment aspect of this thing, be aware that the Kansas Unemployment Commission fielded more calls in 1 day last week than it typically gets in an entire year. So they are really bogged down. You can anticipate your employees being somewhat frustrated by that process, but that's where we are just in terms of the sheer volume. The Families First Coronavirus Response Act took effect yesterday. So all the stuff we talked about on our prior webinar is now in effect. We just got the regulations providing additional guidance on how to apply several key aspects, the most important of which I'm going to try to cover today. But as of now, you could have employees requesting that paid time leave off, and there's processes that you should be following to try and track that leave so that you can then get reimbursement from the federal government for your costs. I believe that Maria and Greg were able to incorporate into the materials that you will be receiving as part of this webinar a request for leave that I prepared as part of it that we are distributing to our clients that we're just getting out to everybody on this webinar as well. So you can track people who request leave and use that as part of your documentation when you get the reimbursement for that leave, or you have the payroll reduction if you're audited as it results to it. So now I'm going to move on and start talking about the CARES Act. This is the first yellow magic marker moment. This CARES Act, which is basically the enhanced unemployment and the loans, was enacted just a few days ago, and the loans become available as of tomorrow. I don't want everybody to drop off the webinar now and call their banker, but as soon as we get done with this, if you are really anticipating that you will need to take out a loan, you should get a hold of your banker immediately. It is expected that the volume of requests for these loans will be immense. I talked to a banker yesterday at a large commercial bank out of New York, and just their clients alone are expecting to submit 3 million of these loan applications, and they're going to do it as fast as possible to get at the front of the line. If just those 3 million people take out a loan of $100,000, that gets us to the 300 billion mark out of 350 billion that has been allocated. So this money is going to run out quick, we believe, and could be gone within a week. So start getting that process going now if you're considering doing this. So what is this CARES Act loan I'm talking about? Here are the 3 basic elements of what the CARES Act does. The Paycheck Protection Program loan, which is the one that I'm going to focus more on today, because that gives all small businesses, many of which you probably are, given the definition, an opportunity to take out a forgivable loan. And by forgivable means you never have to pay it back if you meet certain criteria. And we'll cover the amount here in a second. That'll be our second yellow magic marker moment. How much can you take out? But you can take out this forgivable loan to cover the costs of your payroll and some of your rent, utilities, and those kind of costs for a period of 2 months, 8 weeks effectively. So that's a big deal. In addition, if you do not take advantage of the Payroll Protection Act, and that is something you all need to be aware of, these programs all to a certain extent are going to cancel each other out. If you take out something like the payroll tax credits at the bottom, you then can't take out a Payroll Protection Act program. So be aware, you need to look at your various options and pick the one that is best for you. If you just can't do the payroll or the Paycheck Protection Program because you have to lay everybody off, you just have no business. For example, restaurants in town here in the Kansas City area where I live just had to lay everybody off. They just have no business. They're really not going to be able to take advantage of the Paycheck Protection Program loans. They're looking to get their employees covered and get them compensated through the enhanced unemployment. Bottom line is, not one size is going to fit all with regard to these programs and the availability for all of you to help out during this time of need. I will tell you this, if you are not looking to lay people off during this period and you anticipate maintaining your current payroll, you really, really, really need to be looking at these Paycheck Protection Program loans. If the federal government is effectively going to cover 2.5 times your payroll amounts for this period, it is a very beneficial program that can help you get through this time of need if your business has declined a lot. So what does that mean? Here's what the Paycheck Protection Program does. It amended the Small Business Act to provide 100% federally guaranteed and probably forgivable loans for people during a certain period. Those are loans taken out between now and June 30th. Who can take out these loans is any employer that has fewer than 500 employees. That includes employers who are small businesses, nonprofits, even independent contractors or those who are self-employed or sole proprietors can take out these loans. There's a special provision for people in the food service industry, which you see there in the smaller bullet points, that really won't apply to most people on this call, but it is available in case you're some sort of perhaps bigger business because you're a franchise operator of multiple restaurants or something, for example. The loans will be made through the Small Business Administration through authorized lenders. Virtually any commercial bank that is FDIC insured is going to qualify. So whoever your normal banker is, I would obviously start there, because if you've got a relationship with them, you have a better chance of getting your loan application expedited. And that is something that you would want to do, again, to get in line. The normal requirements for an SBA loan, that you can't have credit elsewhere, that you got to provide a personal guarantee, that you've got to have collateral, and any administrative fees you would normally pay for such loan are all waived. You don't have to do any of that. This loan is very much for you unless, and this is a really important yellow magic marker moment that you see there in red. If you anticipate laying a lot of people off between April 26th and you cannot bring them back, or June 30th, then this loan is probably not for you for the reasons we're going to talk about. If you have to have such huge layoffs in that time period, then the loan becomes less and less forgivable by the number of employees you've laid off as compared to your normal workforce. So this loan may not be for you. If you're planning to do that, you'll have to go a different route. This, as I've said, is potentially free money to help you during this time of need. If you really, you'll see what you have to attest or tell the government when you ask for this loan. But if you believe you are going to suffer as a result of this economic downturn, by all means, you should be considering this loan and talking to your banker now. That website you've got right there, and again, I think you've all got the PowerPoint slides or can get them shortly. But that website is the direct link to the SBA page about all of the loans that I'm talking about today and all of the other items I'm talking about today. So when you need to start looking into this, that is the website you would really want to go to get started. So let me tell you what you can do under this program. The law allows you to get one of these forgivable loans that is equal to up to $10 million, which most of you, that's probably not going to be your amount. You get the lesser of 2.5 times your average monthly payroll costs for the 1-year period before the date of the loan originated. So you look at all your payroll costs back 1 year and then determine what your average monthly was, multiply that by 2.5, and that's the amount of loan you can get. There's an alternative method for computing it if you're somehow a seasonal business industry, but most of you, I anticipate, are not going to qualify for that. You're really going to be looking at the regular calculation process. Here is the next magic marker moment. Payroll costs are not just salaries, wages, commissions, cash tips or equivalent that you would normally pay an employees. You also would include in your payroll costs what you paid people for vacation. If they took a paid family medical leave or something like that in that period, or sick leave. If you had to separate somebody and you had separation costs involved with that. And here's a big one. If you pay for your health insurance for employees, you can recover that cost as well. So if you subsidize, they pay part premiums, you pay part premiums, you can recover your part of those premiums. That's a huge cost. It's not just wages. If you made contributions to retirement benefits, you get that back as well. You also can count in this loan what you pay for state or local taxes on assessed earnings. So when we talk about this 2.5 times multiplier, it is all of the items on this page, not just your wages that you pay or the salaries that you pay. It is a much bigger amount that you can try and get and apply through this loan process. What you cannot include, and this is a big exclusion, if you have an employee that you pay more than $100,000, you can only include in the loan amount you're requesting up to $100,000 for that employee. You can't include it if it's so for example, if it's an employee you pay $200,000 to, in your loan application, you can only include up to $100,000 for that employee. So that's an important number. You also can't include federal taxes that are imposed on this. You cannot include if any of you have employees who reside overseas. And there's a set aside for the Families First Coronavirus Response Act. If you pay out sick time to somebody for that, you cannot use this proceeds for that because that would be double dipping. So you'll have to work with your accountants to make sure if you are paying items out, or you cannot include this in the request for your loan, and you cannot use it as part of the forgiveness number that we'll talk about in a second. But overall, for the most of you, that is not going to be an issue. Here's who the lenders will consider. So here is the slide that tells you whether you can be covered. Were you in operation as of February 15th of this year? Yes. Do you have employees that you've paid salaries, payroll, taxes, or 1099s to as a result of this? Obviously, if that's the case, then yes. Here is what you have to certify when you request this loan. You have to certify that the loan is necessary to support your business's ongoing operations due to the uncertainty of current economic conditions. You don't have to prove somehow that you've been economically damaged. You've just got to certify that you expect that you could be economically damaged as a result of this. So this isn't for somebody really who doesn't expect any business disruptions. If your business is going to be doing fine, then this might not be for you. If you're unsure about it, then this is definitely something you should be considered. The second thing you've got to do is certify that the money you get will be used for appropriate purposes. To maintain your payroll, make mortgage interest payments, make lease payments if you rent property, and if you've got a utility cost, you can use this loan for all of those things. I'll cover that in more detail in a second. But the bottom line is you would be taking out 2.5 times your payroll costs, which is roughly approximately, let's say 10 weeks, 11 weeks, and then you have to use that money in an 8-week period. So you would be paying a lot more than just payroll out of this loan you take out. You'd pay for your utilities. You'd pay your rent payments for your business. You'd pay for the interest on your mortgage out of these payments. So this is a very beneficial loan above and beyond just your payroll. So here's what you could use it for. So you take out the 2.5 times your payroll cost as a loan. Here are all the items that I mentioned you could use it for during the period of your loan. This is a date you want to write down. The period of your loan is the date you get it and up until the 8-week period after you get it. That's the period of time that you could use that loan to pay all of these costs that you see on this slide. It isn't from February 15th till April 15th. It is directly linked to the date you get your loan, and that'll become important here in a second. But you can use it for all your payroll costs. You can use it to continue your health insurance for your employees. You can pay their salaries, commissions. You can use it to pay your rent if you rent your space, and you can use it for utilities and interest, as I said. So it's a very, very broad amount that you could use this loan for. If you do that, and this is the next yellow magic marker moment, this is what's important. If you take out that loan, it is 100% forgiven, which means you don't ever have to pay it back. It doesn't go against your credit. It is just a loan that is forgiven by the federal government because the federal government's going to pay it for you. If you use that money for the 8-week period after your loan originated to cover these costs. So what your forgiveness cannot exceed, obviously, is the principal amount. You wouldn't do that because you wouldn't get more forgiven than you took out. But it is considered a canceled indebtedness, and it doesn't go to your credit rating or in any way impact your credit because the government's going to pay it on your behalf. Here is the kind of documentation you would need to retain so that at the end of this period, you go to your bank and you will have to show your bank proof that you used it for the intended purposes. So you would have to go at the end of your 8-week period, you would take the documentation showing the number of FTE equivalents that you maintained during that 8-week period. All of your costs, things like your payroll filings, other documents that prove that you did in fact use it appropriately, such as canceled checks, receipts, whatever you've got to maintain it. So if you go get one of these loans, obviously you'd be maintaining this payroll, your payroll records anyway. You would be maintaining the checks that you paid to whoever is your landlord or whoever you pay rent to, whoever you pay utilities to. Those are the kind of things you'd have to show. You will provide that to your banker at the end of the loan, and your banker will then certify that amount to the Small Business Administration. They will review your items and then give you notice of whether or not all of your projected and all of the items you spent it on were certified such that your loan is forgiven. If you're keeping these kind of records, it should be a pretty straightforward and easy process. Here is where it gets really interesting. And why I said earlier, if you are planning on laying people off, then this might not be the right thing for you, because the whole purpose of this paycheck plan forgiveness and is to paycheck protection, as they call it, is to try and keep companies from laying people off, to minimize the disruption to operations, to make sure that once this crisis, the medical crisis, is behind us, that we can jumpstart the economy right away. So they reduce the forgivability of your loan if you're laying people off, or if you reduce their salary or wages by more than 25% during your loan period. So here's how they do that. They'll take the total amount of your loan, and then you will divide the number of employees you retained during the 8-week period for your loan by the same number of employees you employed a year ago. And if you significantly reduced your employees during that loan period, then you can see that ratio is going to come up with a number that you would have a reduced loan amount. There's an alternative way you can do that. So you would divide the number of employees, your FTE, during your loan period by either the same period basically in 2019, or if it's more to your benefit, you could use the 2-month period in 2020 as well. You pick whichever one's better than you. Here's how I've actually talked to a client about this. This is a small business that in the time period last year that's relevant, they owned about 24, or they owned, that's exactly the wrong word. They employed 24 employees. Right now, they employ 30 employees because they've grown a little bit. But they do anticipate that they're going to have to cut back due to the crisis. So they're going to lay off 6 employees right now. That would mean they would have an FTE equivalent, they think, during this period of 24. Even though they're actually reducing their payroll a little bit by 6 people, the ratio would stay the same if they use the date in 2019 to do their math. If, however, they were to use the date of 2020, January 1 through February 29 of 2020, they would show that they reduced 6 employees. That would not be good because that would reduce their loan forgivability. So obviously they will use the February date to June date of 2019. So you can see that you're going to have to evaluate, and that's why this is not just a cookie cutter law. You're going to need to talk to your normal counsel. If you've got employment counsel, you're going to need to talk to your banker. You're going to have to evaluate what strategy is best for you when you're trying to balancing, do I go for this loan? Do I not go for this loan? Do I lay people off? What do I do? How do I do it? It is a very tailored approach that is going to be very unique to your own business. The good news is, ultimately, if you don't need or don't use the money, you can pay it back. The law does have a no prepayment penalty requirement. So ultimately, if you did not use all the loan you took out, you can either keep it as a loan that goes forward with a period of up to 10 years and interest of not higher than 4%, or you can just pay it back and be done with it. So you're going to have options here as business people to make that evaluation. But this forgivability is very, very important. Here is one point I do want to make out. There's a very interesting provision under this law that says we recognize that many of you might have had to lay people off already. Excuse me. So if you are in that category, if you lay off somebody between if you laid somebody off between the date the law became effective, which is the covered period is 2/15/20, and you lay them off before the 30-day period after the law was enacted, which means if you lay anybody off before April 26th of 2020, you don't have to count those people in your ratio of forgiveness if you bring them back to work before June 30th. So the bottom line is you could lay people off now, and as long as you restore them by June 30th, when you do that mathematical computation of the ratios, you would not have to count them against your ratio. What does that mean? That means you could use any excess money to cover other things, like your rent, like your utilities, whatever it might be. So this is a one kind of a loophole, if you want to call it that, but it's really designed to, in recognition that some employers had to move forward with layoffs already, to forgive that kind of thing. So what you should be thinking about is to maximize your loan forgiveness. Consider those options. Consider how you do that math. Consider the flexibility you might have as a business, and decide how you would truly implement any reductions if you have to, how you decide to apply for your loan. All of these things are factors that you would want to be taking into account as a businessman. Now, one thing you have to be aware of is if you cannot bring those people back by June 30th, then you would not get that forgiveness. So to a certain extent, you're playing poker here a little bit if you lay somebody off right now. But we also don't know what it means yet. The regulations haven't come out to fully explain what it means by restoring the person. For example, if you bring them back on June 29th and then lay them off again on July 1st, are they going to recognize that as a forgiveness? I got to believe when the regulations come out, they won't do that, but that is unknown to us at this point. I would anticipate they would say you have to bring them back and retain them for a certain amount of time to get that credit. So what happens if you do have that balance? I mentioned this earlier. It becomes a loan that matures in 10 years. The interest rate cannot exceed 4%. You do get deferred payments on the interest and fees. There is no prepayment penalty, as I discussed. And the SBA, by the way, is supposed to be giving us more guidance 15 days from now on all this stuff we're talking about. Here's the problem. I absolutely believe if you haven't taken out one of these loans between now and the next 15 days, there won't be any money left. There's a possibility there won't be any money left Saturday because they're starting to take loans out tomorrow. That's what some people are worried about, is that the government didn't fund this. Now, the possible good news is they may add more money to it if Congress passes it, but there you'd have to be trusting the federal government's going to add money, and that's not something that I'm really confident in right now. So I tried to walk you through some examples here of what this could mean for your business. Let's just use this example. Let's say you have 25 FTE employees and that your average payroll per hour cost is $25, all in, including health insurance, all of the items that you're allowed to take. Just roughly, that comes to an average monthly payroll of about $108,000 for your business, which means the total loan amount you could take by multiplying that by 2.5 is $270,000. If you're not let's say you take it out on May 1, even though again I think the money will be gone by then, you can use that $270,000 to cover your payroll costs. So if that is essentially you getting free money to cover your payroll costs for that period. I don't know what it would do for your business to have $270,000 to spend on these things. The reality the federal government's doing for you. But for most businesses, that's a pretty good amount of money. That's a nice benefit to have right now in these time of needs if your business is going to be troubled by this economy we're going into. This next example is if you have some layoffs. I'm using the same numbers as before, so the first part of the calculation is about the same. But let's say halfway through your 8-week period, you've got to lay off people. And you lay off 15 people just because you had no business and no work for them to do. When you do the math and calculate your FTEs, your average FTEs were 17.5. So you divide your FTEs of 17.5 during your loan period by the 25 employees that you had during the period a year ago, back in 2019, that yields a ratio of 0.7. You multiply that by the amount of your loan, that means only $189,000 of that loan is forgiven, and the other $81,000 is not forgiven. so you either want to pay that back or you want to get rid of that loan amount so that you don't have to pay it back if you don't want to. Otherwise, you could keep it and just maintain it as a normal loan for that 10-year period. However, here's that catch I mentioned before. If you lay the people off before April 26th, using all the same math that we just did and all the same number of employees, and you bring them back before June 30th, using whatever definition that the SBA comes up with by restoring their employment, your average FTEs stays 25 people, and you do not have to have any amount of that loan that is not forgiven. Now, you might ask yourself, well, my payroll is going to be a lot lower during that period because I laid off a lot of people, and that is true. And in which case, you could use that excess money to pay things like your rent, your utilities, etc. Any amount you don't use during that 8-week period, again, that does then become a number you have to pay back. So there are different options here for you to talk through and think through depending on your own business needs. Again, you talk to your normal employment counsel if you've got some about this, talk to your banker, talk to the SBA, and they're going to give you some more advice on how it works specifically for your business. It's at this point that I have to tell everybody, I expected, based on the number of questions we're already getting and just the way this process has worked, that many of you might have questions afterwards. I've said many times, talk to your normal counsel about it because they're already set up with you and they can help you through the process. If you don't have counsel that you can talk to, give me a call and we'll try to work through it. But ethically, there's things I will have to do at some point before I can actually give you direct legal advice. And many of you that have received emails from me after this, the first program, know what I'm talking about. I can't render legal advice ethically in the state of Kansas without doing conflicts checks and that kind of stuff, which I would have to do. But I will try to do that as quickly as possible if you want to pursue that route as well. So that is the PPP loans, as they're calling them. That is, for most of you, the best option for you. There are also other loans that are available to you through the SBA where you would typically go through the normal processes. And this is one of them that you could be considered. It's the emergency injury disaster loans that they're talking about. This is a new loan that you might be eligible for. You're eligible for it throughout the entire year, 2020. To do this, there are certain rules involved, and there are new informational requirements that you would want to talk to your small business administration about, but basically, and your bankers about. Basically, if you are not going to go after a PPP loan, this is an option for you to be considering if you think you might need some emergency disaster assistance as a result of this program. This is going to be much more normal as compared to normal disaster loans you can take out. There are some forgiveness of the process that are available, so it'll be a streamlined loan you might be available for, but in general, it is one that many of you, if you've ever had to take a loan like this out, are familiar with, and if you're not, obviously the SBA is going to be familiar with that. So these are emergency EIDL grant loans that are available to you if necessary. There's another aspect of this CARES Act that provides for payroll tax credits. So again, if you are not going through, the bottom bullet talks about it, if you're not going to go through a PPP process, you could use this one. You cannot do both. So this is an either-or requirement. Don't forget that. So don't apply for these because if it's a lot lower money, you think ultimately for you, if you would get more through the PPP of loans. So these are an either-or. You can see on this slide who is qualifying for this, what it's basically for here. It's a refundable payroll tax credit of up to 50% of your wages. And you can see it's up to $10,000 per employee, so it can be fairly significant. But many of you, if you do not qualify or do not want to take out a PPP loan, would have this available to you as well. The last one I'll talk about here, what this one does, by the way, is and I'm not going to go through this because I don't think it's going to apply to most of you, but this is how you would go about looking at the delayed payment of the payroll taxes so that you could see that process. I wanted to get it for you, but in the interest of what we've got time today and to try and get to questions, I'm not going to cover this aspect in great detail. The next part of this CARES Act is the unemployment that you've been hearing about. everybody should write down the number 488, $488. That's the maximum weekly benefit that is available to an employee who is laid off or furloughed or maybe totally lost their job as a result of this crisis in the state of Kansas. On top of that 488, assuming they qualify for the maximum, and people may or may not, depending on how much you paid them, and whether they're otherwise, how much they paid in during their base period, all the normal calculations that apply in Kansas. But whatever they're entitled to, whether it's $200 or $488, the federal government is going to add $600 a week to those employees who've lost their compensation until July 31st of 2020. That's basically 4 months of up to $1,088 an employee could draw for unemployment. In addition, the federal government put money in to let the states extend their normal payroll or normal unemployment losses up to a total of 39 weeks. Now, after July 31st, it wouldn't be at the enhanced $600 amount, but it still is an extra safety net if the world hasn't changed and turned around throughout the remainder of the year, essentially. The other thing it did is it did cover a lot of people who otherwise would never be entitled to unemployment. Self-employed, and you're now have suffered a significant loss in your revenue during your base period. So you would get significantly enhanced benefits if you are a self-employed person. I saw a question early before we got started on the webinar. What if you're a business owner and you are W-2 yourself also as an employee? You could count, if you're going for a Paycheck Protection Program loan, you would count your own wages up to $100,000 towards that loan, and you could do that loan forgiveness for yourself as well, in part to pay yourself for your own wages. Likewise, if you're going to unemploy yourself because you're not going to be working as a result of this, and let's say your business is what's a good example? A plumbing business, and you normally are 1099 or you're self-employed, you can draw unemployment as well if you're going to be losing this. So there's two different ways you can cover perhaps your own wages as a business. Again, talk to your lawyers and accountants about how you might be set up yourself. But there's ways that this pandemic assistance applies way beyond the definition of somebody who's traditionally eligible for unemployment benefits. So as I was saying, everybody's going to be different. Everybody, how you treat yourself is going to be different. For example, are you presently operating? Do you expect that you will continue to be operating, but that you will see some decline in your revenue and decline in your abilities to operate? If so, then the Paycheck Protection loan may very well be something for you, because you're going to keep operating, but your business is going to suffer some losses. That's what this loan is all about. Are you going to be laying off employees? Have you already laid them off such that they don't count towards your ratio if you hire them back? Or are you going to have to lay them off after April 26th and during your loan period, in which case you're going to have some forgivability issues? So what is your projection for the staff? How are you really thinking you're going to get through the next year? What is your cash flow situation? Are you in such dire straits that you immediately have to get people off your payroll because you don't have the cash and you need to push them to unemployment? That's something you might have to be considering. So you really have to look at that. And again, I want to point out, I haven't made it clear already, if you're thinking about, well, let's just play wait and see, I'll decide if I have to take out a loan later and get one of these PPP loans, I'm telling you the money won't be there if you don't act quick. So if you're thinking about doing that, do it quickly, do not wait. So that is the Paycheck, the CARES Act, and all of the new stuff that became law last Friday, and that really can start impacting on your businesses starting tomorrow when you can apply for these loans. If you've already put employees out on unemployment, they will start seeing that $600 in their loan or in their unemployment benefits going forward now as well. So I'm going to move on from that, and I'm going to move fairly quickly through this next part. I know we're scheduled to do this program for about an hour, but I will stay on the line and we'll try to answer as many questions as we can afterwards. So I want to switch over to the Families First Coronavirus Response Act. This is the program that we all covered before, and I believe that program was recorded for anybody who didn't participate in that last time, so that you can go back and get the basics of that. But we've got some significant updates since then. The Department of Labor has issued some FAQs. which you can go to their website at www.dol.gov and see those FAQs, and they kind of walk through some pretty specific answers. Those FAQs were then even further supplemented in the new regulations. Those are about 200 pages and are written, unfortunately, mostly for lawyers and people to do. But you can also look at those regulations if you have specific questions and insomnia and want to bore yourself to sleep at night, because they provide further guidance on that as well. In addition, at DOL.gov, every single employer that's covered under this law, which means you have fewer than 500 employees, was obligated to download and put the new poster up in their workplaces. If your employees are all working from home now because you're going to telework due to the Kansas shutdown, you're supposed to email them a copy of this poster. So everybody needs to have done that and be doing that now. That was supposed to go into effect as of yesterday. Well, last week when we did this slide, I believe I used this, but this basically walks through the paid FMLA leave component of the Families First Coronavirus Response Act so that you could cover that. Keep in mind, this is the expanded FMLA leave if somebody needs leave due to care for a child who is been removed from school or on daycare. There have been some changes to that on the new regulations that I'll go over in a second. But this slide really kind of walks you through the basics if you have employees that are unable to come to work because they got to stay home and care for their kids. Amazingly, I've had dozens and dozens of calls from clients who are already experiencing this since it kicked in yesterday. If you think about it, if you've got employees with younger children and they want to stay home to care for them because they've been kicked out of school and they can't get daycare, they basically are going to get 2/3 of their pay for up to 12 weeks to stay home with their kids. So that is the one I am seeing the very most requests already coming forward from clients of mine who are having issues with that. Also keep in mind that all of this money is still 100% paid by the federal government. So if you have employees doing that, you're supposed to be reducing whatever your payroll taxes are when you pay it. If your payroll taxes are less than the amount you're paying out in leave, the government's supposed to be cutting you a check for that amount, and they're claiming they will get you that check within 2 to 3 weeks after your request. So that is some of the updates on this part of it. The other part, the emergency paid sick leave, is the element where they get 2 weeks of pay at either 100% of their wages, up to $511 a day, or their regular rate of pay if it's less than $511 a day. As that's a pretty hefty wage, as you might imagine. If they're taking leave to care for someone other than themselves, which I'll cover in a little bit more detail because that did change as well, then they get 2/3 their rate of pay, up to a maximum of $200 a day during this sick day entitlement that they have. And obviously this sick day entitlement is much broader than the leave to care for a child who's been removed from school. So that is the summary that I used last time. This slide did not change since we last spoke a few weeks ago. So what is this about? Here's where we've got some developments. What are the qualifying events for the 80 hours of paid sick time? And by the way, I do want to remind everybody that 80 hours is prorated if somebody's not a full-time employee, if they're a part-timer or something like that. The qualifying events for this are your employees could be out on leave if federal, state, or local quarantine or isolation order has been put in place. That counts for what the governor did in the state of Kansas. So if you have, the statewide in Kansas, as we all know, we're supposed to be handling this shelter at home or whatever you call it, the order from our governor. So you might have employees right now that are staying home for that reason. They could apply for and get this paid sick leave during this time. If you have been deemed an essential business under the Kansas governor's order, and thus employees are coming to work, if they need leave for a qualifying reason, they would not get it for this because they are not subject to a local quarantine order right now because they have been deemed essential and are supposed to be at work. But if they need leave for one of the other things we're getting ready to talk about, and you're operating because you're an essential business, they could take leave for one of the next reasons. But right now, if you are not operating and your employees are obviously then not considered essential and they're out, they could apply for it and get 80 hours of pay right now for those of you that are not essential. The second thing we're looking at here, and by the way, as I mentioned earlier, We did develop a firm as a law firm, or a form as a firm for our clients to use so they can document people that have asked for this kind of leave, and so that they can then use that to go back and get their money and verify why they needed the money back from the federal government. So that form is available to you as well in the materials as part of this webinar. The other reason that is somebody could take this 80 hours of paid sick time, this has been supplemented as well. And the unique one, this has always been, if a healthcare provider said you need to stay at home because I believe you've got COVID, that has always been covered. Or you've got the symptoms, and I believe you need to get diagnosed and you need to stay at home. Those things have always been covered. What's new is that parenthetical there. If a healthcare provider tells an employee, you've got a healthcare condition, you've got severe diabetes, you've got COPD, you've got a heart condition. If you get this, you are extremely high risk of having a problem. So I am telling you, even though you currently have no symptoms, you have no reason to believe you've got COVID-19, I am telling you to stay at home. That person could take 80 hours of this paid sick time as well. And they would get it at their full pay up to the $511 mark. That is brand new. That is not how we thought this would be interpreted, but that is in the new regulations that came out yesterday. The other element, if somebody is experiencing the symptoms and seeking medical diagnosis, been covered all along. This next one, caring for an individual subject to the stay-at-home order, or that has symptoms or has been advised to self-quarantine, all those things above. This is not for the employee's time, so this is to, at the lower rate of pay, 2/3, not their full pay, up to $200 a day. And what's changed here is that they've defined what a close family member is, or if they're caring for an individual. So the individuals that people can stay home to care for isn't just some friend they know down the street. It has to be a close family member, spouse, parent, child, somebody like that, or somebody that they share living space with. So if they are not married, but they've got a significant other and they share living space, that is somebody they could stay home to care for, that they're sharing the living space with. So that is a definition of who they could apply for leave under this one. Next, there's been some changes in this provision if they're staying home to care for a child. I really believe this is the biggest thing that we're going to get. This one is in red because it overlaps with the paid FMLA talked about above in the first slide. Here, they can stay home to care for the child, and they could stay and get 80 hours of their pay at this, and then they could take an additional 10 weeks under the paid FMLA leave above for a total of 12 for that particular event. Here is where they've added some information for us. They say that they can only take this leave if there is not another suitable care provider to care for that child. So for example, if your employee says, hey, my child's been kicked out of school for the rest of the school year, I want to take now through the end of May off, whatever the normal school year would be, to care for my child. And you know that that employee's spouse is a stay-at-home spouse and always provides care for their child. Well, you could say to that employee, well, look, I know your spouse is at home. I know you've got a family member that typically cares for these people. I know that person is suitable and otherwise could be doing it. I'm not going to grant you this leave because you've got somebody already available to do it. And they would somehow have to prove to you that that person's unavailable. So that is better than I thought it would be, and that definition is helpful. And then the last one is a catch-all. If the Health and Human Services says, hey, look, there's very similar conditions to COVID-19 that if an employee is experiencing, we just assume they not come to work. We'd assume they wait it out. Then also they could get this paid sick time. That is the new emergency paid sick leave changes and clarifications we've received since the law became effective. There's been a few different ways, and I'm not going to spend a lot of time on this because I really want to pass it over and get some questions answered. They've given more guidance on how you calculate somebody's regular rate of pay for determining what they get, their average rate of pay. They typically look back 6 months. They would include if you got commission employees, if you're a restaurant and you tip your employees out and you have cash tips that you count towards their wages, you would include all of that in what you would pay and be able to get reimbursement for. If they are part-time employees, you look at a certain average in a 2-week period in the prior 6 months, and you could calculate it that way. So they did give some more guidance on that and how you would calculate that. Once you calculate the regular rate of pay, this slide kind of walks through determining your average for those people that move up and down. This slide talks about the stacking. I mentioned it briefly just a second ago. There is one thing under the paid sick leave and the paid family medical leave that overlaps, and that is taking time off to care for your child. So this slide is designed to walk you through an example. You get a total of 2 weeks for the paid sick time, up to 80 hours for all of the different things that you could take leave for. So if you get sick yourself and you use all, or if you have an employee who himself gets sick and uses all of his or her 80 hours for that, they've used it all. They don't get 80 for their own illness and then another 80 for another family member or whatever. It is a total of 80 over the course between now and the end of 2020. However, if they are home because they have a child whose school is closed or they can't get them into their daycare provider, they could take their 80 hours of leave under this law, the paid sick leave law, and then take another 10 weeks of leave under the paid FMLA law for a total of 12. They can't take 2 weeks here and then stack that, the paid FMLA leave on top of that for a total of 14. Likewise, they have clarified a point that we were not sure about when the law came out. If somebody has already used their normal FMLA leave, if you're an employer that has more than 50 and you're covered by the Family and Medical Leave Act, and somebody has already used their 12 weeks of leave for something already covered traditionally under the Family and Medical Leave Act, they can't use any of this new paid sick leave, which is a long way of saying you get 12 weeks total of family and medical leave, whether part of it's the unpaid stuff that existed before or part of it's the new paid stuff that exists now. So that's how that works. Going on, documentation. When you get to the end of the day, the IRS is going to say, we are going to want proof that you used this for an appropriate reason, that you did pay these sick time to employees for stuff that was covered, and that's the only way we're going to make sure it was done appropriately. They may audit you, they may do whatever. So keep your documentation. If you use that form that we generated to show that somebody applied for it, great. If you get a doctor's note from a doctor showing that the employee had COVID and need to stay out for their 80 hours, great. If you get something from your school or your daycare saying that it's closed, or if it's on the website, print out that, take a screenshot and print out that website right now so you can prove that the school was closed. Keep that documentation in case the IRS looks for you to demonstrate what you needed by way of this paid leave. Here's another interesting question that came up that the Department of Labor answered. And the question revolves around what happens if my business just closed. I couldn't keep operating. So I am not operating during this period. Or even if you could operate, now you can't operate because the government says you shouldn't be operating unless you're an essential business service and you close down as a result of that. Can my employees still take these paid sick days or paid FMLA leave while I am shut down? And they answered that question with a no. So if your employees are furloughed and you don't have them coming to work because you didn't need them, or your business is entirely closed during this process, you do not have to be paying these paid sick days. And in fact, you should not be paying them. In that instance, employees would go draw unemployment. And keep in mind, they'd be getting that enhanced unemployment, which includes the additional $600 from the feds. So for a lot of employees, this isn't a tremendous hardship unless they were fairly high compensated people, that were making more than, roughly $50,000 to $60,000 a year. If they're making that much or less, the $1,000 a week is going to come pretty close to making it up for them. So that is how they've answered this question. What do we do if we've furloughed somebody, or if we've closed entirely? Do we pay these paid sick days and sick leave? The answer to that is no. They've also provided additional guidance on what do we do in terms of continuing health coverage during this period. This slide, it covers that for you. Typically, you would keep the health insurance up if it's the paid FMLA leave or the paid sick leave. so you would not have a gap or lapse in coverage. So you've got that covered on there as well on how you're going to be covering your health insurance costs if somebody's out on one of these protected leaves. I'm going to talk about this, and then I think I'm getting close to the end of the slides, but as I said, we'll start taking questions here in a second. We're up to close to 30, so not too bad. If you are a small business with fewer than 50 employees, this law has an exemption to say, you're so small, we cannot provide leave because it would create a hardship. The regulations provide guidance on what you would have to show if you wanted to say we are not covered by this law. You'd have to show one of these three things: that providing this paid sick time off would be so expensive for you that you would not be able to operate. That's going to be very, very hard to do in that element unless you have a lot of people requesting leave, and the lag in the money you would get from the federal government won't cover you, and you just don't have the operational capital to survive. So that's going to be a pretty difficult one to meet, mainly because this is paid for by 100% by the federal government, and you should not have a problem getting the money back if you can carry the wages for a period of time. The second one is the employee being out from your business would create a significant hardship to you because of those employees' specialized skills, knowledge of the business, or responsibilities that they do. If that is the case, you could deny employees in that very unique category the right to take leave. Likewise, so it doesn't have to be all of these things, it's obviously one of the three. There are not sufficient workers available, willing, and qualified to do the work that you need, and requesting the leave would put you at a significant hardship. That is another reason you could say, look, we just don't have employees around to replace them. They don't have unique skills or abilities. We just don't have enough people around to replace them. I cannot have them gone. They've got to be here. And if that is the case, then you could deny them the leaves that we're talking about here. So they did provide some more guidance on that in the regulations on who would be able to accept out certain people from the thing. If there are any healthcare providers on this call today, meaning you operate a hospital, a clinic, a doctor's office, a nursing home, you know that you've got a separate exception that applies to you, that you can and are expected to be continue and operate during this crisis, and you would not have to provide leave to employees under this crisis if they need to be at work for providing the services that you do. So that is something, I did my best to keep it right in an hour to cover all of the stuff that I wanted to cover today. And now I don't know how we're going to do it, whether Maria, you or Greg are going to do it to field the questions, but how did you want to start going through the questions?
Hi, Tim. I think the easiest way for now is I'll just start reading off the questions and we'll run through them and see how that works for you. When we run out of time, then we'll take the list and try to get those answered the best we can afterwards and send them out to everyone. Does that work for you?
Sounds great.
All right, let's start right off. If you're an incorporated business and any of the shareholders or officers also receive W-2s as employees, are those wages excluded?
That question is going to the CARES Act and one of these payroll protection plan loans. And basically, you would be able to include anybody who's an employee, including yourself, up to $100,000 again. So when you go to your bank to make this application, you could flag that for them and say, hey, we're employees as well, so we've included this. They're going to tell you to count yourself up to $100,000.
All right. I have two questions that are similar, so I'm going to read them together. I have a credit union for my bank, and they have not been doing SBA loans in the past. Is this going to be an issue?
Yes, it is going to be an issue because if they, even though they haven't been doing these loans in the past, it doesn't mean they could not start doing them. But I think out of an overabundance of caution, you should try to find a bank that you know provides these kind of loans and go to them first, just because then, mainly because of my concern, as I mentioned many times now, that this money's going to run out, and I wouldn't want you to be dealing with somebody who might not know how to do this quickly and get it done for you. So yes, technically anybody who's insured by the FDIC can provide these loans, but if they don't have experience and haven't done it in the past, then I think you might run into issues.
Okay. And this one's similar to that, but and I think you've answered it, but I'd like to clarify anyway. If your bank is not an SBA preferred lender and you must go through a third party to submit to the SBA for the PPP, is it possible that the money will run out before those normal community banks get the paperwork submitted?
I cannot emphasize enough that this money is going to run out. So
Okay.
do everything you can through whoever you think is best suited to do it quickly to get your request and your application in as fast as you can.
Okay. If an employee files for unemployment, does that disqualify an employer from applying from either the EIDL or the PPP? Or are they only not permitted to use the expenses from those loans for payroll if the employees are not rehired?
Excellent question. Whoever answered that, asked that question, you obviously have read this through and have some level of sophistication. I don't know with regard to the EIDL. I have not focused as much on that. We've got a whole task force in our law firm. I've got another partner of mine who's doing that side of things for our clients. So if you're thinking about that, I would have to put you in touch with them. But the PPP, it doesn't disqualify you if somebody files for unemployment at all. And if you laid them off during the period that doesn't count towards your full-time equivalent, then it also doesn't go towards the forgivability of the loan if you bring them back by June 30th, as I said, or as you say in your question, rehired them. But the fact that people go out and draw unemployment does not disqualify. You'll just have to be monitoring and doing the math to make sure you do use all the money available to you during the 8-week forgivability period. Because if you got a lot of people out on unemployment and your payroll's dropped a lot, you might not have anywhere to spend that money if your rent and your utilities aren't otherwise costing you that. So this is where your accounting and your planning and your knowledge of your payroll would definitely come into play.
Okay. Are religious nonprofits eligible, i.e. a private Christian school?
Yes, nonprofits are included in the PPPs, and that does include religious entities as well. So if you're talking about applying for a loan, you would be able to go and talk to your banker about it just like any of the rest of us do.
Okay.
I want to think, if you're a nonprofit, I assume you're a 501c3 because they make it clear that it is 501c3s, and I don't think the limitation otherwise, but if you're a separate form of incorporation somehow as a school, then I think you might want to talk to your normal attorney as you go through it, but as we understand it, those are covered.
Okay. If after 8 weeks of a loan, we expect to lay off employees due to work slowdown from the virus, is it best to use the time period May 1 to June 30th as 8 weeks, assuming we have the loan approved?
The mechanics of this are going to be such that we believe that the loan, the 8-week period starts when your loan is approved and you get the money. So you wouldn't necessarily be able to space out when you use it because it's going to start when you get it. But if you read the forgiveness section, let me just walk you through an example because that might be the best way to answer this question. Let's say you get your loan April 15th, and that's when your loan period starts, April 15th to whatever 8 weeks is after that, sometime in June. When you look at forgiveness, the ratio that they look at is whether you had to lay people off during your forgiveness period. That's the 8-week period of the loan. So if you keep everybody employed during that 8-week period, and then afterwards the economy is still really hitting you hard and you have to lay people off and you just can't keep them, they don't go against your ratio. So the law envisions, and their goal is to try and help you keep people employed for 8 weeks during this critical period that we hope the real crisis passes. And after that, if it didn't help you enough, then you can go about your business of laying people off and reducing them, and it won't impact on your forgivability.
Okay, I think that's going to answer a couple of questions I have down the line too. So we don't have a health plan, but we do provide some money for our full-time employees to help pay for their own health insurance. Can we include that money we provide them?
Wow. That's one I would like to follow up with whoever answered that question, because what the regulations say and what this law says is that you can use it to cover payroll costs as it's defined here. And when it defines the payroll costs, here, I'll read it to you exactly so you can hear it. It says, payment required for the provisions of group health care plans, or group health care benefits, excuse me. I don't know if you subsidize an employee to get health insurance outside that isn't a group plan that you provide counts. That might be one that we do not have an answer for until the IRS issues the regulations that they're supposed to implement this law. So my just off the cuff, and again, I'd like to talk to whoever answered that question maybe at a different time. I would talk to your banker when you apply for it. Tell them what you do by way of a supplement. And I don't know how you supplement it. Maybe you supplement it by increasing their wages, in which case it's already captured as a wage. But talk to your banker about how you do it. And if they say, no, we think this is covered, go ahead and include it in your application. And then you'll have the money in case you need it and can count it. And by the time you would pay it out, we would then have the guidance from the IRS as to whether it's truly something you could use it for. So I would err on the side of asking for it and not and maybe not using it, rather than not asking for it and then needing it, and now you don't have it.
Okay. Next question is, do we get to include part-time employees? And if so, how do we calculate the wages?
I believe this is a CARES Act, a PPP request, a question. And the short answer is yes, you do get to include part-time employees, and you would calculate their wages just like everybody else and average out that way. So yes, you get to include part-time employees. I'm just going to use an easy example. When you're doing your forgivability calculation, it talks about FTEs. So it doesn't just talk about full-time employees. It talks about full-time equivalents. So if you've got 2 half-time employees, just to do the math right, I'm a lawyer, not an accountant, you would add those 2 together and they equal 1 FTE because they're both half-time. Or if you've got 4 that are 25% time, they are added together to 1 as well. So definitely you can include part-time employees.
Thank you. Please clarify if we can or cannot use FICA and FUTA in the loan calculation amount.
What the regulations say when you're talking about the amount that you are applying for, the term they use, they don't make it as clear as we'd hope. They say you can include as payroll costs payment of state or local tax assessed on the compensation of employees. So that's the clarification. That's a question, I'll be perfectly honest with you, I've never addressed before because I'm a lawyer that does employment law issues. I normally deal with companies who, can we fire this employee? What do our policies say? What do we do with our unions if you're union? What do we do with our wages? What can we pay? All that kind of stuff that I just have never got into the tax side of it. So I don't want to mislead you. Whoever does your payroll taxes or your accountant would be able to tell you if the term payment of state or local tax assessed on compensation of employees is included in that or not. So I don't want to mislead anybody and try to give advice where I'm not competent.
Okay. How broadly are health care premiums defined? Does it include benefits like disability and life insurance?
No.
Okay.
Unless they're wrapped into the premium of your health insurance.
Okay.
It only includes group health care benefits and retirement benefits. It would not include something like a disability benefit plan. However, I know a lot of places that those are all incorporated into one insurance that you're paying. So in that case, it could be, in particular, life insurance. I know a lot of health insurance plans automatically include a life insurance. So in that instance, yes. But if you've got a special plan that is a disability plan, that is not, for whatever reason, included in this list of documents that they talk about, or excuse me, this list of payroll costs that they list in the statute.
Okay. If an employee makes more than $100,000 with 2 different companies combined, is it a 100,000 max per person per company, or just 100,000 per person total?
That's a very, very nuanced question, and whoever wrote that, I think I want to talk to them about that, because my assumption is there that these two companies might somehow be affiliated by one owner or something like that. And if that's the case, that's what we got to double check how you would count your $100,000. I do not believe they would let you count, let's say $100,000 under one subsidiary and then another $100,000 under a different subsidiary. I do not believe they're going to let you count $100,000 for both businesses because they would look at them as one employer. So I think in all likelihood, depending on how people do this, you're only going to be able to take out $100,000 if you're in that situation as described. But that is one I do not feel comfortable at answering in totality without further discussion, or if you're going to talk to your normal employment counselor and banker about that as well. That's one you definitely want to raise with them.
Okay. Are lease payments for equipment used in operations considered rent for the purpose of the loan calculation?
No.
Okay.
This only applies to rent on building space.
Okay.
So they're talking about, that's why they let you take out your mortgage interest but not your principal to cover it. So you can only cover rent on a building space, not equipment or other things that you might be utilizing.
For interest, does non-secured debt incurred prior to this event count?
Interest on non-secured debt. That question goes towards what you can use this for. So when we look at how you would use it, you could, and I'm going to read it to you. You can use it for payroll costs, which is what we described before. All the amounts you could do it. You could then use the amount of your loan for payments of interest on any mortgage obligation. So that's your rent. And then your rent for your buildings. You could use it for utilities. And then you're talking about the last element of this, which is interest on any other debt obligations that were incurred before the covered period. That is something that is further defined on, but basically I believe you can use it for interest on other debts. And you can't use it obviously for any principal. The government's not going to buy essentially pay off your mortgage for your property. But on other debts that you incurred before the covered period, which is again defined as the February 15th to June 30th in this case, you could use it for that kind of stuff. Yes.
Is an ESOP eligible for the loan?
Let me pause there for a second, because there's two ways to answer this. Obviously, is the ESOP eligible for the amount you could take out on the loan, and then can you then use the covered costs? That is a great question, and again, I'll apologize where I don't know it because I haven't answered it. I'll have to look into it later. I don't believe so. I don't believe that's a payroll cost that is listed that you could get a loan that would be included in what you can get the loan for. And I also don't believe you could use the proceeds from that, because when it talks about what you could get the loan for, it talks about payment of any retirement benefit that you might be making. I don't know that an ESOP qualifies unless it's somehow filtered in or attached to your retirement plan. And most are not, by the way.
I own a small fast food restaurant and have a number of part-time employees. Would this loan cover their wages? I think you answered that.
Absolutely, yes.
Okay.
Yep. And by the way, if you're a small fast food restaurant, there are special provisions under this loan that if you owned 20 restaurants and had, I don't know, 50 employees at each, such that your total employment number in that instance is 1,000 people. In that instance, you actually are still a business covered by this. You're still considered to have fewer than 500 people, because they look at the restaurants and hotels are put into a special category for the purpose of this paycheck forgiveness situation. And they don't look at your total number of 500. They look at each location independently. So you, whoever that is, and if you happen to have a whole bunch of franchise operations such that you're over 500 employees and you think, darn it, I don't get covered under this, you are in a very special category and you could still be covered. Doesn't sound like you are, but if anybody else on the line operates a lot of franchises, we should talk because you're probably in a special category of people. And I happen to know that because I represent some of the biggest franchise operators in the country in the quick service restaurant industry. So you're unique.
Okay. You did mention that we were going to have a printout of the slideshow. Is that something that we can provide to the participants?
Sorry, aren't you guys doing that?
I do
Yeah.
have it. We'll go out.
Yes, I'll take care of it. I'll take care of that.
Okay, that answers the question. Thank you.
Yeah, the slides that I've done here are 100% available to any of you. If you have any trouble, and by the way, do you guys also have the, Greg, did the Word document come through, or
Yes.
Maria, with the model form that I put together?
It did, and it will be included as well.
Okay,
And-
so everything I've talked about is available to everybody on this call.
It will also be on our website by tomorrow.
Great. I think you've already answered this question, but I'm going to say it anyway. If operations have ceased, but I wish to retain my employees, can I use this loan to pay their wages, even if the business is not operational?
I believe the answer to that is going to be no, because if you've ceased operations, oh, wait a minute. Let me back up there a little bit, because I want to make sure we don't confuse the two different laws here. If you've ceased operations under the Family First Coronavirus Response Act, you could not be using money to pay for the paid sick leave, because the law says once they're furloughed or not working, they would not be eligible for that. If, however, you are trying to keep your employees engaged, and I work with a manufacturer over in the St. Louis area, they are down for now because they don't have business. But what they're asking employees to do is during this period to keep up on their training, to go back and review the OSHA compliance manuals and all of the stuff that they would need to do to make sure their employees are fully trained. They're even doing some legal training during this time period. So they're keeping them employed more or less, even though they're not reporting in. They're essentially working from home. You could definitely use a PPP loan for that kind of thing, even if people are not actively at work at a place, because you've got them at home and you're saying, well, I want you to remain available. I want you to stay active and on the payroll for a normal work day. You could use it for that kind of amount, yes. If they're just sitting at home doing nothing, I don't know. I think there could be a risk when we get the final regulations out that they provide further guidance to say that you can't just pay people to sit at home. But that is a fantastic question, and I would encourage you to shoot me an email so I know who you are, and we could do a follow-up once the regulations come out to see whether that's an appropriate use of these funds.
All right. What if an employee chose to no longer work due to their concerns of the virus? They're not sick, they're just panicked and don't want to work.
Great question. I'm going to have to break it down. I apologize. This is going to take a little time for everyone, but this question has come up multiple times with my own clients, so I assume many of you have this. If you've got an employee, category 1 employee is somebody who is just perfectly healthy, have no underlying health conditions. They're a younger person that is, as we all know about this virus, is less likely to be subject to it, but they still don't want to come to work. That person would not qualify for any of the paid leave because their doctor's not telling them to stay at home because of a condition. That person, you could say, look, I'm operating. Our business is essential, so we're operating. Otherwise, they wouldn't be operating in Kansas right now, and the way it works. So you're operating. You've got a totally healthy person who has no reason to be out. You could say you need to come to work. And if not, you could do something as much as terminate them. Or alternatively, you could say, look, I understand your concern. I'm going to try and operate based on the people who are willing to come to work. And so what I'm going to do is I'll put you on an indefinite leave. What that person could then do is get unemployment benefits in all likelihood. Normally, if there's work available, et cetera, they wouldn't be eligible for that. But under the example I just gave, you don't need them because you've got the work covered with others. You could put them on a layoff. It won't go against your unemployment rating, and they'll get the extra benefits. Now, the problem with that is everybody might be saying, well, why is Joe going to sit at home getting $1,000 a week to do nothing. I'm coming to work and busting my butt, and I'm only making $800, depending on what your wages are. You might have that kind of challenge to work through in that scenario. But bottom line is, if somebody is just healthy and doesn't want to come to work, you've got options. Now let's talk about employee number 2, category number 2. They've got a health condition, and their doctor says that person should not be coming to work because if they get this condition, they run a higher risk of dying. Or they're older, let's just say. They don't have a health condition, but they're older, and their doctor says don't do it. In that instance, you would have to provide up to the 80 hours of paid sick time because they do fit into that new category that the regulations elaborated on yesterday. So person number 2 is somebody that the doctor says they shouldn't be coming to work. They've got an underlying health condition. They could qualify for that paid sick time. Person number 3 is somebody who is, let's say the doctor doesn't say they've got it. Well, actually person number 2 could be person number 3 as well. Let's say that they're got a condition and the doctor says they shouldn't come to work. They get the 80 hours. In addition, that person may get a note from the doctor that says, this person has an underlying health condition that qualifies if you are FMLA covered, meaning you have more than 50 employees, et cetera, and that employee has worked for 1,250 hours in 12 months for you. I have seen already some doctors that are saying this person, because of their underlying health condition, it is an undue threat for them to come to work, so I want them out on FMLA leave. In that example, person number 3 would also get the first 80 hours paid because the doctors put them out, and then they may be eligible for 10 more weeks unpaid of FMLA leave. Again, we really got, on a call like this, and when I don't know all the facts, that's the general way I think you would handle that. But I do encourage all of you to talk to your regular employment counsel about that very unique set of facts, because that is one area where the law is absolutely not certain. And I've talked with some other lawyers already who don't do employment law, who did not give that advice, and I think they're potentially committing malpractice because they're not walking through that FMLA component and possibly the ADA component, which applies to much smaller sized employers, the ADA, because you might have a situation where the employee says, I know I'm not eligible for FMLA, but I've got this underlying health condition, severe diabetes. Would you, as a reasonable accommodation, excuse me, allow me to stay out of work until this crisis reduces? And you may have to consider that as an accommodation if you're covered by the ADA as well. Again, those are very, very highly sophisticated analysis. It has to be drilled down to the employee by employee level. So that's the basic advice I would give you, but that's one you want to talk to somebody about if you find yourself in that situation.
Okay. Next,
sorry, that was kind of a long answer for that question.
That's all right. Next, we had a couple of questions about the PPP interest rate. I'm assuming that's on the amount that's not forgiven. This morning we had a webinar from the SBA, and they were saying that it was a 0.5% rate and a term of 2 years. Can you clarify that?
It varies, because I think that this morning might have been talking about the emergency relief loan, and that's a different period. If it's a PPP loan, the interest rate can be no higher than 4%, and the term can be 10 years. So the different loans are going to have different terms. So I don't know which one you might have been talking about before, but that's how the Paycheck Protection Plan loans are scheduled to be no more than 4%, and the loan period that they specify is up to 10 years.
And I might add, from talking this morning on it, that there's supposed to be a lot more clarification coming out after it gets open tomorrow. So that should help with a lot as well.
I sure hope so, because there's still, the risk is, unfortunately, that by the time that clarification comes out, all the money's gone. So I know there's a lot of challenge out there.
Absolutely. There was also a question on whether or not you were going to be doing a presentation on the EIDL. I would point out that we had one this morning that is currently on our website for recording from the SBA, and we also have 2 more next week. So if you're interested in that, we can certainly, we have the SBA coming in and doing those regularly. Of course, we'd be welcome for your input as well. It's great to have all this information and love coming from two different angles.
Yeah, definitely that is going to be your better source than I am. I just don't do banking law. I'm an employment lawyer. So what's available on the other side that Greg just mentioned, I'm so glad that the resources available to people through the SBA for that as well.
Let's see. Kind of answered several, so I'm having to slip through here. If an employee takes the FMLA, does that count against your FTE calculation on the PPP?
Employees out on family medical leave. Yeah, you would not have to count them if they've taken a leave of absence against your ratio, because they're still an FTE. They're just not actively working. And that's a great question. So if you get an employee, let's say they're having a baby or whatever, and you're covered under the Family Medical Leave Act, so they're not actively at work, I don't believe, first off, I don't think anybody, you've thought of a question that the government hasn't thought of yet, but I do not believe that would count against your FTE equivalent for your payroll, because they are still an FTE.
Let's see.
And Greg, I hate to do this to everybody because the questions are so great, but I backed these things up fairly close. So I've got another one that I got to start preparing for in about 10 minutes. So I can keep going for a while, but if you've got
no problem, you
a whole
just
bunch
let
of
me know
questions
when
that are similar, you want to prioritize, shoot them to me that way.
you bet. And you let me know when you need to go, and we can certainly let people know that we'll get these answered as best we can. So self-employed on security does not draw a wage. The business is closed and the owner has a heart condition. Can the business owner apply for a loan for utilities and rent only?
Whoa, go back on that. That was a lot of facts to unpack there. So
It really is.
Read that one again if you wouldn't mind.
Sure. Self-employed on security, Social Security, does not draw a wage and the business is closed because of this, presumably, and the owner has a heart condition. Can this business owner apply for a loan for the utilities and rent portion only?
I'm going to have to say I wouldn't do that. And the reason I say that is unless the self-employed person pays themselves some sort of wage or similar to that, and it doesn't sound like it if they're out on Social Security. And the reason I'm saying that is if the only reason you're taking the loan out was your rent and utilities, but you don't have any employees because you're out because the business is closed, you would get zero forgiveness of the loan, just how that question is basically set up. Because the FTE equivalent and the forgiveness goes towards the number of employees employed, and you might be in a tough position there and unable to get any of that loan forgiven. So that's a great question to talk to your banker about, just to make sure, or your employment counsel about to make sure. But I believe you would be entitled to zero forgiveness, and thus you'd be taking out a loan for something that you'd have to pay 100% back.
Yeah.
You might be in the category that might be better off considering a different type of loan than this one, depending on the loan rates, like the disaster loan that I know Greg mentioned earlier.
If you have an employee that has been laid off and you try to restore them by 6/29, but they do not want to return, how does that affect your forgivable loan?
Obviously, I'm hesitating because that's a great question. If you've got a job for them and you want to restore them, but they're refusing, could you count them, is essentially how I read that question. And that is one that they do not answer in this new law. They just say that you've rehired or restored them. I believe you'd call that a rehire or a restoration, but that is also an area where I think we're going to get further guidance on what counts as a rehire or a restoration. And when we get the regulations and guidance that we're supposed to be getting. So I would give you a tentative answer, which is I think you'd be able to count them, but that answer is going to be dependent on the final guidance we get. So I don't think I can really give you a definitive answer on that.
Okay. Here's one that's really interesting. Optometrists were told by the CDC to postpone routine vision care. We are available for emergency care, which is the essential business component. Can I continue to payroll the essential doctors and use the FFCRA sick leave for non-essential staff?
Yes. So what we're talking about here is you are a healthcare provider that is doing an essential function. So you are expected to be operating at this time. And oh boy, wait a minute. Let me think about that again. Because I assume from the question, you have furloughed the non-essential staff or laid them off or whatever you want to call that. In which case they would be drawing unemployment at this time. If that is the case, then I'm changing my answer to say no, you could not give them paid sick time under the FFCRA because they are furloughed employees and they're not actively supposed to be at work. They would be getting their relief and their compensation at this time through the unemployment system.
So it really
which again is significantly enhanced, so it's better than what it would normally be, but you would not be paying those people because, and the reason I'm really trying to drill down on that is if you pay them and you can't get the money back from the government, that comes right out of your own pocket. And you just don't want to do that if there's that risk. I think you'd want to rely on the unemployment system. Now, obviously, the essential people that are at work, it sounds like you've got some that are there to perform the essential functions. And by the way, I've had it's amazing to me how many dentist's office, physical therapy office, even certain doctors' clinics I'm talking to now about this, because they're in the exact same situation as you. They're only providing essential services, so they have laid a lot of people off. And so the essential services that are being provided, if somebody needs to take leave and they're working, then they get the paid sick leave or the paid FMLA leave. But if they are not essential, they're at home because you furloughed them and pushed them out on the unemployment, then those individuals would not qualify for this paid sick time. And whoever asked that question, by the way, there is a big opportunity that some of these people may be working part-time and not others. It's probably not an all or nothing proposition for your business. And you might have some of these other people that you want to have doing part-time. So they would fall into another category, and that is somebody who is working part-time. And if that's the case, they would be entitled to these paid sick benefits if they need it while they're working part-time. They're drawing unemployment for the rest of their time because they just don't have enough time, so they qualify for unemployment. So they could be getting paid from you, they could be getting paid unemployment from the state of Kansas, and they could be getting the extra $600 from the feds all at the same time in any given week. So that's why I've said many times, it is not a cookie cutter kind of approach. Greg, I think I've run out of time here. I gotta have a little break before I start this next one. So I apologize, folks. Again, I'll do my best if you have follow-up questions and you want to talk. If you reach out through Greg and Maria, or if there's a list of questions that we haven't answered, or if you just reach out to me directly. I put the first slide back up so that you would have my contact information. I just got too many of these things going on these days with so many different entities that are trying to get guidance on this. So hopefully, Greg, I'll wind it down here. Hopefully everybody's found this beneficial in giving you some guidance. Go talk to your bankers as soon as you get off this call. If you're really looking at a PPP loan, because I really want you to get in line in that in case they're going to run out of money. And that's all the time I would have today, Maria and Greg. Thanks for allowing me the chance to get this word out to another group of people or to this group again, and hopefully it worked out and helps out a lot of people.
Thank you so much, Tim. I really appreciate your information and your willingness to help us.
Sounds good. Everybody take care. I'm going to sign off now, and I'm going to try and get my voice back, drink some water, and get ready for my next one. So everybody take care. Be very safe out there. And Maria, you in particular, I hope you're feeling better.
Thank you.
All right. Take care. Bye.